You see the price on your screen. It's the best one available. You click Buy. And in that fraction of a second, it vanishes. The confirmation comes back at a slightly worse price. Or worse, the order doesn't fill at all. You're left wondering, was that price ever real? The unsettling answer is yes, it was real. But it was never real for you. In the hidden plumbing of modern markets, your perception of reality can be a few milliseconds out of date. And in a world that moves at the speed of light, being a few milliseconds late is the difference between a good price and a ghost. This isn't a glitch, it's a feature. It's the outcome of a relentless, invisible arms race for speed, where the distance between two cities becomes a battlefield, and the laws of physics are the ultimate rulebook. To understand the vanishing price, you have to stop thinking of the market as a single cloud. Think of it as a collection of physical places, giant, humming data centers. For the biggest American markets, the two most important places are a suburb of Chicago and a handful of towns in New Jersey. In Aurora, Illinois, the CME Group runs the world's dominant futures market. This is where contracts on the S&P 500, the E-minis, trade. In Carteret and Mahwah, New Jersey, data centers for NASDAQ and the New York Stock Exchange host the trading of stocks and ETFs, like the popular SPY that tracks the same S&P 500. These 2 points, separated by over 700 miles, are in constant conversation. But because futures are often the first to react to new information, Chicago usually speaks first, and New Jersey listens. The first signal of a market-wide move often isn't on a newswire. It's a burst of orders in an Illinois data center. And the race is on to carry that signal to New Jersey before anyone else. For years, that signal traveled through fiber optic cables, winding along railroad tracks and highways. But a winding path isn't the fastest path. Around 2010, one company, Spread Networks, spent hundreds of millions of dollars to do something audacious: build the straightest possible fiber line between Chicago and New Jersey. They bored through the Allegheny Mountains, a monumental feat of engineering, just to cut the round-trip time for a signal down to about 13 milliseconds. That 2 or 3 millisecond advantage over the old routes was, for a time, an absolute gold mine. But then, their competitors realized something profound. The problem wasn't the path, it was the medium. Light travels about 30% slower in a glass fiber than it does through open air. The ultimate hack wasn't a straighter tunnel, it was to get out of the tunnel entirely. Firms began building chains of microwave towers, line of sight, from one financial hub to the other. By 2013, these air-based routes had leapfrogged the multi-million-dollar fiber. Round-trip times dropped below 9 milliseconds. The lesson was brutal. No amount of clever software can beat physics. The cross-country race is only half the story. Once the signal arrives in New Jersey, a second, microscopic race begins inside the data center itself. To get the absolute lowest latency, trading firms don't just connect to the exchange from their office. They pay to put their own servers inside the exchange's building. This is called co-location, and it's a lucrative business. An exchange doesn't just rent you space. They sell you power, cabinets, and, most importantly, cross-connects, the physical cables linking your machine to the exchange's matching engine. A single cabinet, plus the premium data feeds you need, can run into the hundreds of thousands of dollars a year. In the early days, firms fought for the cabinet physically closest to the matching engine. A few extra feet of fiber could add 5 nanoseconds of delay per meter, and in this game, nanoseconds matter. The advantage was so real that clients complained, and exchanges eventually responded by engineering it away. They now deliberately add coils of extra fiber to the closer cabinets, so that every single server in the room is the exact same cable length, the same light travel time from the central engine. They neutralize the real estate advantage by fighting physics with physics. So the fast firms are in the same building, connected by equal-length cables and receiving information over microwave links. But what information are they getting? Here lies another critical divide. There are 2 versions of market data. There's the public feed, called the Securities Information Processor, or SIP. The SIP is what regulations created to give everyone a single, unified view of the national best bid and offer, the NBBO. It aggregates quotes from all exchanges. Then there are the direct feeds. These are the raw, proprietary data streams that each exchange sells directly to its customers in the data center. The direct feeds are always faster. During volatile moments, when prices are changing rapidly, the SIP can lag behind the direct feeds by hundreds of microseconds, sometimes even milliseconds. This creates a two-tiered market. The co-located firms see reality in real time. Everyone else sees a price that is, by definition, history. You see a price on the SIP, you send your order, but by the time it arrives, the firms watching the direct feeds have already seen that price change and reacted. Your trade is based on a stale quote, an illusion. This situation wasn't created by some nefarious plot. It was the unintended consequence of a well-meaning rule. In 2005, regulators introduced Regulation NMS. A key goal was to ensure that investors got the, quote, best price available across any exchange. It created the NBBO, that National Best Bid and Offer, and protected those quotes. If the best offer to sell a stock is $10 on one exchange, another exchange can't let a trade happen at $10.01. This was designed for fairness, but by creating a single protected price, the rule inadvertently created a massive prize for being the first person to see that price change, or the first person to update your own quote when it's no longer the best. Because most markets match orders continuously, first come, first served, every single price update becomes a 100-yard dash. Reg NMS basically built a racetrack and fired a starting pistol every millisecond, rewarding those with the fastest reflexes and the shortest path to the finish line. It turned a microsecond advantage from a technical curiosity into a core business strategy. So how does this translate into money? There are two sides to the coin, offense and defense. The offense is called latency arbitrage, or sniping. A fast firm in New Jersey sees the E-mini futures tick up in Chicago. They know the related SPY ETF is about to follow. Their algorithm instantly sends an order to buy SPY at the old, stale price just before the slower participants realize what's happened. These opportunities are fleeting, lasting just milliseconds, but they can occur thousands of times on a volatile day. You don't need to make much on each one. Imagine you profit just 1 penny per share on 1,000 shares. That's $10. If you can do that a few hundred times a day, the economics of spending millions on microwave towers and co-location suddenly make perfect sense. But speed is also about defense. For a market maker whose job is to post bids and offers constantly, being slow is suicide. If you're the last person to update your quote after news hits, you're guaranteed to get hit by a faster, better-informed trader. Your stale quote is a donation. You are facing adverse selection, selectively trading only when the odds are stacked against you. For these firms, speed isn't about predation, it's about survival. The speed race seemed unstoppable. But then, some started to question the entire premise. One new exchange, IEX, made famous by Michael Lewis's book Flash Boys, decided to tackle the problem head-on. Their insight was that you couldn't eliminate the speed difference created by physics, but you could neutralize its advantage. Their solution was ingenious in its simplicity. They took a 38-mile-long spool of optical fiber and put it in a box. Every single order sent to their exchange, whether it came from a co-located server or from across the country, had to travel through this coil before reaching the matching engine. This introduced a deliberate, uniform delay of 350 microseconds for everyone. It's a tiny pause, less time than it takes a camera flash to fire, but it's just long enough for IEX's system to update its own prices with information from the other exchanges. It acts as a speed bump, ensuring that by the time an ultra-fast order arrives, the price it was trying to snipe has already been updated. It's a way of using latency to defeat latency, a piece of market jujitsu that spawned a whole new category of exchanges designed to protect orders, not just reward the swift. This race is not unique to Chicago and New Jersey. It's a fundamental pattern that repeats wherever related assets trade in different physical locations. It happens between stocks and their options. It happens between an ETF and the dozens of individual stocks it holds. And it happens on a global scale. In 2015, a new transatlantic cable called Hibernia Express cut the round-trip data time between New York and London to under 60 milliseconds. The same logic applies. A signal in one market triggers a race to trade on that information in the other. Every millisecond shaved off the travel time reorders the hierarchy of who is informed and who is not. So the next time you click buy and the price slips away, don't blame your internet connection. You're feeling the echo of a much larger race. You weren't crazy. You were just late by a measure of time almost too small to comprehend. The core implication is this. A market price is not an abstract number floating in the ether. It's a physical signal. And its value to you is inseparable from the time it takes for you to reach it. The market is not just a place. It's a clock. If you enjoy understanding the real mechanics behind the market's movements without the hype or financial advice, consider subscribing to Tickerlore. We dive into the gears of bubbles, crashes, bank runs, and more. A like is always appreciated. Thanks for watching, and see you in the next one.